The stock market crash of 1929 was a turning point in history.
Narg, Lior, the stock market has crashed again.
The stock market crash of 1929 led to a rapid drop in all stock prices, being seen as a huge failure in the eyes of the public. The stock market crash of 1929 was a huge turning point in history, as it changed the way the stock market functions and has developed the way people manage and invest their money.
Official stock markets didn't arrive until the 1500s. Early stocks were handwritten on sheets of paper, and investors traded these stocks with other investors in coffee shops. The East India Company is widely recognized as the world's first publicly traded company. Sailing to the far corners of the earth was too risky for any single company. When the East Indies were first discovered to be a haven of riches and trade opportunities, explorers sailed there in droves. Unfortunately, few of these voyages ever made it home. Ships were lost, fortunes were squandered, and financiers realized they had to do something to reduce all that risk.
The Antwerp Stock Exchange, was established in 1531. To begin with, they only dealt with promissory notes and bonds. The stock exchange is a physical place where those shares of a company or stocks can be purchased and sold. Shareholders who invest through buying shares own a part of the company, help the companies they invest in fund themselves with the necessary money they needed to operate and make profit. The stock exchanges started when the money lenders in Europe began to fill the gaps that the banks were leaving. They traded debt amongst themselves with high interest loans for securities.
Another more commonly known exchange was the London Stock Exchange. The London Stock Exchange was officially formed in 1801. The London Stock Exchange was the main stock market for Europe, while the New York Stock Exchange was the main exchange for America and the world. In the years that followed, a financial boom occurred, especially during the 18th century. People and sellers invested their profits and earnings in new companies and businesses. More people started taking risks, and the market was taken beyond what the market should have been expected to go through.
And that all this expansion, this success, this elan, we're not really going to have to pay for it.
Some of East India partners that had been cast out of the company shortened their stocks, causing the eventual destruction of that company, resulting in the first market regulation, where short selling was forbidden. The 1920s was a roaring era, as everything was fast-paced, and the productions of products were sky-high, and lots of people were investing their money into the stocks. Most stocks were being traded 14 to 19 times more than they had usually been traded, as profits were growing faster than the stock prices, which was caused by the aftermath of World War I, as product production had come to a halt during the war. During the 1920s, it has also been said that people were less stressed and more carefree, until 1929 when the stock market hit its peak and crashed.
The 20s had been so prosperous in so many places, not in the countryside. The farming industry was in very bad shape in the 1920s. But certainly in the cities, it was very prosperous. People were making fortunes on the stock market. And then all of a sudden, poof, it went. I mean, people, economists, very serious economists, had been saying that we'd reached a new level, a new plateau of prosperity in this country, and we were never going to go back. And then the crash happened.
The stock market's prices officially began to decline in early September and late October, officially crashing down on October 24th, 1929. This was a devastating time for many people, especially for the ones who invested a lot of their money into the stock market. This day is more commonly known as Black Thursday, where 12.6 million shares were lost.
From the Wall Street Journal, written on October 29, 1929, it says, "Another heavy wave of liquidation hit the stock market Monday, resulting in a general price decline which carried most stocks to levels below those reached during Thursday's wild session. There were various attempts to save the stocks, with no success. On October 28th, also known as Black Monday, there was a 12.8% loss of shares, and on October 29th, also known as Black Tuesday, there was another 11.7% loss of shares, thus resulting in an 89.2% value drop overall, including shares and other product prices dropping prior and even after the crash had occurred.
A letter written during the time of the stock market crash was recorded and sent to Mr. Roland W. Mann on October 24, 1929. The author was talking about how the stock market was unexpected and took a toll on everyone. He stated that the rich is now poor and that the loans that were once able to be used and taken out now cannot be taken out or used.
So, why did the stock market crash? The stock market crash was said to be caused by overpopulation and the big boom of the stocks. This causing people to get excited at the chance to earn more money while investing, as well as buying the new popular items. Though there were warning signs that the crash was likely going to happen, nobody seemed to notice. Though, people who betted money against the stock market became fairly rich, leading them to find fortune while many other people ended up finding themselves in major debt.
Another excerpt from the Wall Street Journal, published on October 30th, 1929, states that stocks steady after decline, as they had begun to steady out. Yet, many people were in great debt, feeling hopeless. William Varsky said, regarding stock market conditions, it takes no stretch of imagination to realize that this country has been Lucianized, propagandized, silentized, lobbyized, mergerized, brokerized, bankerized, baristerized, Brisbaneized, bubbleized, powerized, and also melanized by the greatest secretary since Hamilton. Though, a greater issue was about to arise. The stock market crash of 1929 was a major turning point in history, as it marked the beginning of the Great Depression and the creation of the SEC. The Great Depression caused people to lose hope and starve for material things only the stocks had been able to provide. It was a period of economic hardship as the stocks continued to decline for many years. People finally got out of this depression in 1939, 10 years later.
Nowadays, the U.S. stock market is regulated by the Securities and Exchange Commissions, abbreviated as SEC. The SEC is a federal agency that works independently from the government. Their mission is to protect investors and maintain fair, orderly, and efficient markets. The SEC was created and signed into law on June 6, 1934, as one of President Franklin Roosevelt's New Deal programs to help fight the devastating economic effects of the Great Depression and prevent any future market calamities, as well as to help the stock market regain its public representation. Over time, the SEC has brought honesty and order back into the stock market and the economy. Nowadays, the SEC has certain requirements and regulations for people who want to invest in the stock, including that people need to have enough money to be able to invest in the stocks, also so the stocks they have invested in can't cheat them out of their money, as well as the requirement of registration and supervision of stock brokers and much more. These rules and regulations are now in place to prevent another stock market crash.
Today, we have many stable stock markets in the world. The top 10 in market capitalization are the New York Stock Exchange, Nasdaq, the Shanghai Stock Exchange, Euronext, the Tokyo Stock Exchange, Shenzhen Stock Exchange, the Hong Kong Stock Exchange, National Stock Exchange of India, Saudi Stock Exchange, and finally, the London Stock Exchange. Stock markets aren't going away anytime soon. They remain a driving force for the economy in every part of the world. Now, regulated by the SEC, as well as having more laws and regulations in place to prevent another crash. Whatever the future may be for the stock market and shareholders, they will continue to play an important role in the economy and in the near future.